Hey everyone, me Kevin here. I like doubling my money, but I also like not losing my money. And there might be a company that might be able to help us with this pursuit. It's a stepchild of Wall Street. Well, at least it's been treated like a stepchild for pretty much the entire pandemic. And don't get me wrong, there's nothing wrong with stepchildren. I was a stepchild twice. Now, I'm not a child anymore. Anyway, the company that we're going to talk about has been almost completely ignored until, well, Salesforce acquired Slack. And it's interesting because the company we're going to talk about is a company that Salesforce actually invested $100 million in back in 2018. And this company is called Dropbox. You've probably already heard of Dropbox before, but if you're like me, you probably just use Microsoft OneDrive, Google Drive, maybe you use iCloud or Amazon because you got suckered in. Unless, of course, you skip right over Dropbox in the rankings and you go to Box.com. Now, Box.com, not to laugh at them, I used Box.com a lot when I first made my websites back in 2009 and 10 for my real estate business. But anyway, I've got to share a little bit about my philosophy first, and then we got to know about where Dropbox fits in. This is important. It's an important philosophy when it comes to stocks. And no, it's not the philosophy that you should get 4 free stocks with Webull when you deposit $100. Just make sure you actually deposit $100 because otherwise you won't get the second more valuable free stocks. Or the philosophy that you should get life insurance in as little as 5 minutes. No, we're not going to talk about those, even though you could, if you wanted to, in the link down below. Probably by the time you're done with this video, you could be signed up for both. Anyway, the philosophy is that, look, I grew up with companies like Best Buy, Circuit City, and GameStop, and I loved these companies. But I don't buy those companies today because I believe in the long term, Best Buy and GameStop won't make it. They'll end up like Circuit City. And look, that sounds terrible because I love these companies. Best Buy has actually done really well to revolutionize themselves against Amazon, and I think they've got insulation because of their appliance services and their wall TV hanging and the Geek Squad. But the reality is, at some point, we're going to get to a point where these appliances and devices are just too inexpensive to actually send Geek Squad out for, and you're still going to need people to hang this stuff, but I don't know if that's going to keep Best Buy hanging around. The point is, my philosophy is, I like investing in industries where the wind is at your back. It's kind of like sailing with the wind instead of against the wind. And after all, for all the years that I played World of Warcraft, the only saying that continues to pop up in my head is the stupid undead characters, after you're done talking to them, going, "May the wind be at your back." All right, I'm done with that. I just like having the wind at my back. I feel like I'm cheating when I put money into companies like Apple or Amazon or Redfin or, heck, even Etsy. Like, I started buying Etsy at $70 and I'm like, I don't know, they seem like I know they've got good growth, but it's gonna be 2 years before they hit my price target of 150. Yeah, no, 6 months and they're at 170, okay? Like, I like investing in these companies because the wind is at their back. Dropbox, though, is a unique one. See, you might be thinking like, well, come on, like, isn't the wind at Dropbox's back? I mean, after all, it's in an industry where the total addressable market, also acronymed down to this fancy 3-letter word, TAM over here, total addressable market for cloud storage is exploding. In 2019, the total addressable market share or TAM for cloud storage is 46, or was, since 2019 was last year, $46.12 billion. By 2027, we expect this to balloon to $225 billion by 2027. That is a huge explosion. So you've got, major growth coming to the cloud sector. So why would I imply by sharing this story about my philosophy that Dropbox doesn't have the wind at its back, so to speak? After all, Dropbox has market share. In fact, they've got a decent market share. They've got around, probably around 22% market share right now of the cloud storage space. So let's go ahead and drop Dropbox in here and explain what the heck is going on and why we might be a little bit nervous about Dropbox, yet why I might still be making a video about them. All right, so this might be about Dropbox's share. And the cool thing is when TAM gets bigger, the total addressable market gets bigger, basically what happens is every single year you're adding like 22% to this market. The total addressable market grows by about 22% per year in the cloud storage space. And so the neat thing about that is obviously the availability of customers is bigger, but Dropbox has this unique thing happening where their market share is actually declining, like their slice of the pie is actually getting smaller, which is not so good. But because the pie itself, ironically, is growing, they still grow as a company because the pie itself is now larger. So in other words, when Dropbox used to have like a 32% market share and now it's down to like 22%, they're still in this growing industry, right? So it's kind of like you got the wind at your back, but you're in really choppy waters. And this is why Dropbox, as I said, is a unique one. And this is risky because we don't like it when their growth rate falls. Their growth rate, in fact, is probably going to be somewhere around 10% going forward in the future years. And in a market that's growing by 22%, that means you're losing market share. Let's go ahead and look at some of the fundamental financials here. And then I want to talk about why the hell am I even talking about this company? Like, why am I wasting my breath talking about Dropbox if the wind ain't at their back? I mean, what did we just learn about the lesson? Okay, well, this is a spreadsheet, and let me just show you the entertaining stuff, not all the boring stuff, because right now, this looks like the most boring YouTube video ever. If somebody walked up behind you and they're like, dude, what are you watching? Yeah, it'd be bad. All right, so we're gonna try to look at the juicy stuff. What we want to see is their revenue growth. So let's add some beautiful color here. In 2017 to 18, we had growth rates around 31%, 25%, 19% growth. 16% growth, 14.9% growth. Estimated 2021, 10.8%. Oh gosh, their growth rates are declining. Not very good, right? We don't like seeing growth rates decline. To me, I just don't invest in companies where they're declining. But there's something unique happening here, and it has to do first with their valuation. So if we look at their earnings per share, most companies right now, especially after this pandemic, earnings per share are just getting squeezed ridiculously. I mean, it's pretty insane how almost every company seems to be selling for at minimum like a 35 times earnings rate or earnings multiple, especially if it's a tech company. Apple sells for like 37 times earnings. Obviously Tesla, Amazon, Etsy, and some of the bigger recent growth names, Snowflake, some of the ones like DocuSign even with negative growth, negative earnings per share, have infinite multiples, but even the ones that don't have infinite multiples, they've got really, really big ones. Like for example, if we look at Amazon, Amazon's got a price to earnings ratio or multiple of 91. Facebook's right there with Apple. They've actually gotten a lower one, but that's possibly because, well, they might get broken up with all the insane lawsuits we've got going on. They're low at 32. So when you look around the market space, generally you're seeing these big mature companies, Apple, Microsoft, 35 to 37. Facebook getting beat and punched in the face a bit with uncertainty, 32. The real ones with like the big growth, the Amazon, we got that 91 we saw. Etsy, for example, 97, right? These are big multiples that you're paying to buy these companies. Well, if we look at the estimate for Dropbox's earnings per share by the end of 2020, we'll get about 82 cents of earnings. Well, the shares are currently selling for about $24. So $24 divided by 82 cents a share equals roughly 29 as a multiple. So that means dollar per dollar, you are paying less for the earnings at Dropbox than you are at all of these other companies like Apple, Microsoft, Google, Facebook, just getting beat up. And in fact, if we take it a little bit further and we look at, okay, well, what do we think that Dropbox's revenues are going to be like in 2021? And we look and say, okay, well, we'll be at about $2.1 billion, unless they dramatically miss this, of course. The current estimates are that we should be somewhere around $2.1 billion. Well, in that case, we might get about 0.94, so 94 cents in terms of actual earnings per share. Well, if I take the same 24 divided by 92 cents, that gives us about a forward PE ratio of about 26 based on today's share price. That's pretty dang low. And now this is really Wall Street building in a very cheap valuation for this company because people were worried like, hey, if they're declining, if their slice of the pie, so to speak, is declining, we can't pay for them like we can pay for a growth company. We can't pay for them like a Tesla, certainly not. We can't pay for them like an Amazon, certainly not. But the market's saying we're not even gonna pay for them like a Microsoft or a Google or Apple. So what's the point of investing in Dropbox? Well, After the Slack acquisition by Salesforce, which was a $27.7 billion deal, and Dropbox, just for comparison, has a $9.3 billion market cap, Dropbox, even though it might be losing some market share, it has recently come into the news because of a potential acquisition. This morning, The Information reported that ServiceNow, an analytics and workflow company, might be interested in buying Dropbox. Now, even though I don't know much about ServiceNow, I do know that they have a $105 billion market cap and that they've been steadily growing into what MarketWatch calls a cloud software superpower. Oracle, which is a massive multinational tech company with a market cap of over $182 billion, is also being rumored to buy Dropbox. They're all trying to adapt or buy Dropbox so that they can adapt to this new decade, this 2020s decade of technology. But folks, it's not just one article. This is something that's been talked about for quite a while, and it's starting to ramp up. And it's interesting. This is why it's speculative, because we're starting to get that ramp in the amount of, or the frequency at which we're starting to hear about these possible acquisition rumors. In fact, if we look at this New York Times article from December 1st, this is when Salesforce announced that they were going to acquire Slack for $27.7 billion. But if we scroll down, we'll actually see other firms focused on workplace collaboration products, including Airtable, Asana, Box, DocuSign, Dropbox, and Smartsheet, may also be potential targets as high-valued software companies look to roll up the fragmented market for collaboration tools, which they have an entire other article on, again, going into depth about how these sort of companies like Salesforce are basically just trying to create mega companies and having all of the different features built into their product. And so what you're really getting is you're getting this potential, and this is the big reason I'm investing in this, and it's still speculative, okay? This doesn't change anything, but you are actually getting into this environment where it makes more sense for these large tech companies to gobble up other companies so that way they can have a suite of services. It's kind of like how, you know, when you call up AT&T and you're like, look, I just want cell service. And they're like, but come on, if you bundle up with, you know, home phone line, cell phone, TV, and internet, you know, you triple play or quad play or whatever, hey, we'll give you a better deal. Companies love this. They want to be able to cross-sell to their customers. Just for an example here, and I'm gonna be transparent because especially to my course members, I don't think I'm very salesy at all to my course members. Like I think I send out an email like 2 or 3 times a year, like, hey, here's a new course member bundle code or whatever. But my course members, for example, when somebody buys my real estate investing course, and they love it, it's very likely for them to buy the stock course or the real estate property management course. That cross-selling, just as sort of a personal level example, is something that I see regularly. It's totally normal. And like, I'm sure I could squeeze the lemon much more than I do because I barely do. I barely do. I just hate getting emails myself. Like, you can get overwhelmed with spam so quickly. It turns me off. But anyway, you look at companies like Salesforce or these other massive companies like Oracle, it totally makes sense to go around gobble up what's $9 billion when your market cap's $200 billion or more, you know? Gobble up some of these other companies, integrate this service, and boom, there you go. I mean, this one's even a far one, but there was even a mention that maybe Facebook would look into Dropbox. It's like, really? Going from social media to cloud storage? Look, I don't know. The point is, it's speculative. If you do not have the capacity for watching this thing go down to $15, don't buy it. But why own a Dropbox? What's the point? Especially if it's a company that you know, it's kind of shrinking its market share. Well, the big desire for holding Dropbox is speculative at nature. So keep this in mind. If you are going to invest in Dropbox, know that it is speculative. It could, you know, slowly just let the air come out of its balloon and it could go back to $18, $19, $17 a share in theory. Well, the hope that people have is that in the event that Dropbox gets acquired, that we might see the same sort of explosion that we saw at Slack, where when their merger was announced, this stock went from $29 all the way up to $42, an increase of about 44%. Depending on when you bought it, you would have made some decent money in the short term on Slack. Dropbox is not a company that I'm a big fan of for the very long term. It is not a company that I will put a substantial investment in relative to my portfolio. I am going to buy, and I already have, bought 2,000 shares right around $24. I am not willing to pay more than $25 a share for this company because at the very least, if we can see some growth return to Dropbox, we'll see it before the end of 2021. Maybe we could take some profits at the end of 2021, right when we get some long-term capital gains opportunities. But other than that, the goal of owning Dropbox is really just to be a part of the potential that this company gets acquired. It's not something that I'm going to continue to put money into. I've got much more money invested into, for example, Shift Technologies, a great company that I believe in. I haven't invested yet into companies like Nano Dimension or Hyliion, which were companies I reviewed on, made review videos on. Haven't yet invested into Airbnb. That priced well above my targets for Airbnb. I was hoping to get in around 105, somewhere right around there as a maybe. But I thought there was a good chance that stock could skyrocket over 120, and sure enough, it's now in the 140s after IPO. And so that means we would have had no chance to buy it, except for at 140, but that's too expensive. So Dropbox, it's a cheap one, but the big play on Dropbox isn't to hold the thing forever, it's to play a potential merger or an acquisition. That makes this a speculative play, so be careful. Don't put a lot of money into speculative stocks. I generally recommend keep speculating to under 5 to 10% of your portfolio. But these are my opinions on Dropbox. Let me know what you think in the comments down below about Dropbox, and folks, we'll see you in the next video.